Hello there. Welcome to our channel. In today's video, we will discuss how algo trading has evolved over the years. So let's get started. 6th May 2010. The US markets opened the day slightly negative. Quite a normal. There were some apprehensions about Greece's economic situation and the upcoming UK elections. In the afternoon, within 20 minutes, the markets crashed by over 4% and rebounded. For a few minutes, shares of some of the largest companies in the world were available for almost nothing. This event is called as the 2010 flash crash. What happened? Why did the markets crash so rapidly without any major negative news? And how did it recover in minutes? Algorithmic trading is the answer to all these questions. The buying and selling of stocks had always been done on the trading floor, by actual humans in a physical location. Starting from around 1970s, computers emerged. Since then, their presence has only grown. Investors started using them for pretty basic operations. For example, if the price of a PQ stock goes above 90, then sell. If it falls below 80, then buy it. This is something a human can do too. But if a computer does it for you, then you as a person are free and available to do more important things. This is an example of an algorithm, a set of instructions given to a computer. Over time, evolution took place. Computers became faster and more sophisticated. The stock market exchange itself became better at dealing with computers. With that, the instructions investors wrote to computers became vastly more complex. For example, if the price of a PQ stock goes above 90, then sell. If it falls below 80, then buy it. But only if the price of crude oil is below 50 a barrel and before 1 p.m. Even this is still very basic. Today, some investors boast of tracking thousands of individual metrics and signals to decide whether to buy, sell, or wait. There was an example of an incredibly developed system that used to analyze the speech of important politicians announcing major changes to decide whether to buy or sell within seconds. Over the years, these computers started trading with other computers. This gave birth to many entirely new kinds of trading. Some of these computers buy, hold, and sell their stocks in microseconds. Needless to say, computers are expensive. To get an edge over other investors, each investor started buying better, bigger, and faster computers. This is a constant and never-ending race. In the US markets, about 70% of all trades are actually algorithmic trades. In fact, today, almost all large orders are placed with the help of algorithms. For example, let's say a mutual fund wants to invest 150 crore rupees in a stock ABC. The problem with such a large order is if placed at the same time, the stock's price will start rising rapidly while the buying is still taking place. So, mutual funds write an algorithm into a computer that slowly buys the stock over a couple of hours or even days, ensuring the stock price isn't affected by their buying. The problem with algorithms is that all said and done, they're still not humans. Our brains are incredibly complex and can pick up on signals computers can't. In the 2010 flash crash, there was a large sell order placed by someone. Seeing the prices plunge, other algorithms started to sell. They probably were programmed to sell below a certain price. Seeing that, even more computers started to sell, and that led to a snowballing effect. The computers were reacting to other computers selling and not looking at if it made sense. Eventually, some human investors intervened. This is when the market started climbing again. Seeing that, other computers started buying. This is how the flash crash and recovery took place in just 20 minutes. Computers and their algorithms have since gotten much more sophisticated. Still, that hasn't prevented other flash crashes from happening. In 2020, at the start of the pandemic, the markets crashed massively, up to 13% in a single day. Many say the single-day falls would have been much less had computers not been involved. But then, you can't convince investors to give up their computers. They have incredible advantages. Besides being incredibly fast, computers help investors remove biases and emotions, track metrics, analyze other traders, and much more. So far, whenever we've mentioned investor, we meant large institutional investors, hedge funds, mutual funds, banks, etc. What about individual investors? Since the 2000s, computers have gotten incredibly cheap and therefore personal. This has enabled many individual investors to try to use their personal computers in investing. To write algorithms, you'd have to be a software engineer or know how to write software code. The number of coders in the country is increasing year by year. So it is picking up. But are there any advantages to this algorithmic trading? Well, it depends. If you are a long-term investor, algo investing doesn't really have advantages over regular investing. But if you are into day trading, it could help you. It's not an easy fight since a laptop will be competing in the market against some pretty powerful computers owned by institutional investors. Hope you found the story of algo trading interesting. Thank you for watching the video. Please do like and subscribe.